You have $100, not $10,000, not a lucky break, not a crypto coin that exploded overnight, not money inherited from someone you barely knew. Just $100. The kind of money that disappears quietly. A few food deliveries, 2 impulsive online purchases, 1 weekend where you said, "I deserve it," too many times. By Monday, the money is gone and nothing in your life is meaningfully different. That's the amount. And strangely, that's exactly where this begins. Not with confidence, not with financial literacy, not with a 6-hour spreadsheet comparing investment strategies while productivity videos play in another tab. It begins with $100 and a decision so small it almost feels embarrassing compared to the size of the future you secretly want. You make the transfer anyway. You open the app, choose the index fund, set the automatic deposit. Then you stare at the screen waiting for something to happen. Nothing does. Your account says $100. The market moves slightly. Now it says $99.42. You check it again before sleeping as if watching it closely will somehow accelerate the future. It won't. This is what the beginning actually looks like. Quiet, unimpressive, emotionally underwhelming. Nobody talks honestly about this stage because there's nothing dramatic to say. The first 6 months of investing are mostly an argument between your future and your impatience. Month after month, you contribute another $100. The account grows slowly, too slowly for excitement, too slowly for compliments, too slowly for your brain to fully respect. 6 months in, you've contributed $600. The account balance is around $684. You knew mathematically it would look something like this, but emotionally it still feels strange. $684 is not changing your life. You are not becoming wealthy in front of your own eyes. You are building something invisible first, a pattern. And patterns are difficult because they produce identity before they produce rewards. That's the stage where most people quietly disappear, not because they're incapable, because humans struggle to repeat actions that provide delayed emotional feedback. The dangerous part is not losing money. The dangerous part is feeling like nothing meaningful is happening. 1 skipped month becomes 2. 2 becomes, "I'll restart later." And eventually the account becomes a digital graveyard for intentions. A small balance sitting untouched inside an app you stopped opening. This version of you is possible. Not lazy, not stupid, just human. Because discipline without visible reward feels unnatural in the beginning. But you continue. Not passionately, not perfectly, just consistently. That matters more. 12 months pass. You've contributed $1,200. The account balance sits around $1,340. The market helped a little. You earned roughly $140 without directly working for it. Objectively, it's not extraordinary. You could make that money in a few extra shifts at work. But something more important happened this year. You proved to yourself that your impulses are not in complete control anymore. 12 separate times you had $100 that could have become temporary pleasure. And 12 separate times you redirected it toward a future version of yourself nobody else could see yet. That repetition changes people, not externally at first, internally. You begin noticing that your life functioned perfectly fine without that $100. The sacrifice was mostly imagined. The bills still got paid. The emergencies still came and went. Life continued normally. The money wasn't load-bearing. It was impulse-bearing. Most people never test that assumption. You tested it for an entire year and discovered something uncomfortable. You needed less than you thought, and your future needed more than you realized. 26 months in, total contributions, $2,600. Account balance, approximately $3,100. Now the number has weight, not life-changing weight, but psychological weight. The kind of number that interrupts your attention for a second longer when you open the app. Something changes during year 2. You stop checking the account emotionally and start checking it observationally. At first, you monitored the market for danger. Now you monitor it for progress. That psychological transition matters more than people think, because investors who operate from fear behave differently from investors who operate from curiosity, even if they own the exact same assets. Then the market falls. Hard. A correction hits during a stressful season of your life when your emotional energy is already stretched thin. Your account drops from $3,100 to around $2,670. You watch hundreds disappear. And suddenly the calm philosophy of long-term investing becomes personal. This is the moment where identity gets tested. Anyone can invest during optimism. Endurance only reveals itself during uncertainty. Part of you wants to stop contributing temporarily until things recover. That sentence sounds logical. It has destroyed countless futures. But you continue sending the $100. Not because you feel brave, because you decided the system matters more than your mood. That single mindset quietly separates people over decades. 8 months later, the market recovers. Your account crosses $3,900. The shares purchased during panic are now worth significantly more. And for the first time, you emotionally understand something books fail to teach properly. Down markets are not interruptions to compounding. They are part of compounding. Year 3 ends. Total contributions, $3,600. Account balance, approximately $4,750. You are now up more than $1,100 beyond what you personally deposited. The gap is widening, slowly, then less slowly, then eventually faster than feels reasonable. This is when compounding starts feeling less like theory and more like participation. It no longer feels like you are building alone. Time has entered the equation. Time becomes a silent investor contributing beside you every month without fail. You are now 29 years old. 60 monthly deposits. Total contributions, $6,000. Portfolio value, roughly $8,200, assuming historical market averages around 10%. You have over $2,000 more than you contributed. That number is not retirement money. It is not freedom, but it is proof. Proof that wealth is less about intensity and more about sustained direction. Proof that small, repeated actions eventually become financially visible. More importantly, proof that you became someone capable of repetition without applause. That identity matters more than the balance, because balances fluctuate. Identity compounds. 5 years in, something subtle changes in your relationship with money itself. You no longer see spending and investing as moral opposites. You understand structure. You still travel. You still buy things you enjoy. You still live your life. But now there is a system underneath your lifestyle protecting your future automatically. The $100 stopped feeling like sacrifice a long time ago. Now it feels permanent. Like brushing your teeth. Like paying rent. Like gravity. That's what permanent habits eventually become. Invisible. 10 years pass. You are now 34. Total contributions, $12,000. Account balance, approximately $20,500. For the first time, the annual growth begins approaching your yearly contributions. Your portfolio grows by roughly $1,700 in a good year without additional labor from you. This is the stage where money starts demonstrating independent movement. Your past decisions are now working while you sleep. And something strange happens psychologically when people experience this personally. Their anxiety about the future decreases, not because everything is solved, because momentum exists. The machine is finally large enough to help push itself forward. You understand something now that younger people often misunderstand. Wealth rarely arrives through one explosive event. Usually it arrives through thousands of emotionally unremarkable decisions repeated long enough. 20 years in, you are 44 years old. Total contributions, $24,000. Portfolio value, approximately $76,000. The account now generates around $7,000 annually in average market conditions. You contribute $1,200 per year. The machine contributes far more. That's the crossover point people dream about without realizing how ordinary the process looked while building toward it. No genius stock picks, no leverage, no perfect timing, just duration. Most people dramatically overestimate what can happen in 1 year and underestimate what can happen in 20. Because exponential growth hides itself early, then suddenly becomes impossible to ignore. 30 years. You are 54. Total contributions, $36,000. Portfolio value, approximately $227,000. The portfolio now generates roughly $22,000 annually at average historical returns, almost $1,900 monthly, from an amount that once felt too small to matter. The machine you built from repetition now produces income powerful enough to influence real-life decisions. And here's the strange part. Along the way, patience changed you outside of money too. You became less reactive, less impulsive, less dependent on immediate emotional reward. Because long-term investing trains something deeper than financial discipline. It trains emotional stability. 40 years pass. You are 64. Total contributions across 4 decades, $48,000. Portfolio value, approximately $637,000. Over $500,000 generated not from salary increases, lottery tickets, or financial genius, but from consistency surviving long enough to become extraordinary. Every transfer mattered, even the ones that felt invisible. Every boring month, every uncertain year, every correction you sat through, every moment you continued without emotional confirmation, all of it stacked, all of it compounded, and eventually the invisible became visible. That's the real story here, not the money, the transformation. Because somewhere across those 40 years you stopped being someone hoping life would eventually change, and became someone quietly building change regardless of how long it took. That is what investing actually gives people when practiced long enough. Not just returns, evidence. Evidence that small, disciplined actions repeated consistently can completely alter a human life. Most people wait for motivation. Most people wait for the right amount. Most people wait for clarity. Most people wait for someday. But time does not wait. It compounds whatever you feed it. Neglect compounds, consumption compounds, distraction compounds, but discipline compounds too. You gave time $100 every month, and time gave you back a completely different future. Not quickly, not dramatically, patiently, like all real things are built.